Welcome to the Deep Dive. We're your shortcut to getting really informed without drowning in reading material. Today, we're doing a deep dive into the outlook for Indian equities. We're working off a pretty hefty Morgan Stanley report dated August 4, 2025. Our mission: to unpack it all for you, break down the key insights, understand what's shaping India's stock market future. Think of it as getting you fully up to speed on a really critical global market.
And it's worth stressing, this isn't just, someone's opinion. It's a very comprehensive analysis, packed with data, indicators. That's what makes it so valuable. And understanding India's path, its market, well, it matters more and more for you given its global weight. So let's get into what Morgan Stanley sees.
Okay, let's jump right in. The core idea seems to be this re-rating of Indian equities. Why do they think such a big shift is coming? What are the fundamentals?
Right. The report points to a pretty unique mix of factors. You've got strong population growth, a functioning democracy, which isn't trivial, and policies really focused on macro stability, keeping the economy steady. Add to that improving infrastructure, a growing entrepreneurial scene, better social outcomes. It's quite a combination. These are deep structural things.
That's fascinating how those pieces fit together. And the report gets specific, right? It talks about India becoming the world's most sought-after consumer market, also a major energy transition, more credit flowing, manufacturing grabbing a bigger slice. How do these big shifts actually fuel that market re-rating idea?
Yeah, they connect directly to financial health. For instance, India is becoming less dependent on oil relative to its GDP size. That cuts down risk from energy price swings. Plus, exports are rising, especially services. That's a good sign of economic maturity. And crucially, they see fiscal consolidation getting the government's budget in better shape, potentially leading to a primary surplus in about 3 years.
A primary surplus. Okay.
Which implies a lower saving imbalance for the whole economy. And that allows for what they call structurally lower real rates. Think of it like the economy getting more efficient, needing less costly fuel, interest to grow.
Okay, I see the chain reaction.
Exactly. Lower saving imbalance, lower real rates, and less inflation volatility. That's partly better supply chains, partly policy like flexible inflation targeting. Put it all together and you get less volatility in interest rates and less volatility in economic growth itself. The report sums it up neatly. High growth with low volatility and falling interest rates and low beta equals higher PE.
Right, the PE, the valuation multiple.
Yeah.
So break that down. What does this specific mix mean for stock prices? They say it supports a sustained bid on stocks, especially as households put more money into equity. Can you make that a bit more tangible for us?
Sure. Imagine an economy that offers good, steady growth, but with less drama, less inflation risk, stable policies. Investors, well, they're willing to pay more for that reliability. That's why the PE ratio, price to earnings, is expected to go up. It's confidence in the quality and sustainability of future earnings, not just the next quarter. And that low beta point is key too. India being less sensitive to global market swings makes it feel safer. So Indian stocks become a more attractive long-term holding. And you see ordinary households increasingly moving savings from, say, real estate or gold into the market. That creates steady buying pressure.
That paints a compelling long-term picture. But okay, zooming in. What about right now, the immediate future? The report says Morgan Stanley is confident and ahead of consensus on near-term returns. What's the current vibe on the growth cycle?
Well, they acknowledge there was a bit of a soft patch in earnings growth, started back in the second quarter of fiscal 25. But crucially, they think that soft patch is ending now. Even if, the broader market isn't totally convinced yet, that gap creates opportunity. And a big support factor they mention is the central bank being pretty accommodative or dovish.
Okay, so the foundation is strong, the soft patch might be ending. What could actually push things forward? What catalysts are they watching?
They list quite a few potential triggers. Things like better clarity on global growth would definitely help. Domestically, simplifying the GST rates, that's the goods and services tax, getting a final trade deal sorted with the U.S., more government announcements on capital spending, seeing loan growth pick up. They specifically note the corporate bond market waking up. Also seeing improvements across the board in that high-frequency economic data. Even better trade with China could be a boost.
Makes sense.
Yeah.
But there are always risks, right?
Absolutely. They flag the obvious ones. Global growth slowing down more than expected, geopolitics getting worse, maybe a spike in oil prices tied to that, and continued supply chain issues, maybe in things like rare earths or fertilizers. Those are the main worries on the downside.
Okay. And there was something interesting about foreign investors, FPIs.
Yeah, foreign portfolio investors, their positioning, how much they're holding, is apparently the weakest it's been since they started tracking the data back in 2000, which is quite something. But the report's take is interesting. India's low beta, that lower sensitivity to global swings we mentioned, means it tends to outperform when global markets are falling. But it might underperform a bit when global markets are really roaring upwards. So for global investors, it's almost like a defensive growth position. Less downside, maybe slightly less explosive upside.
Right, a stabilizer. The report also uses a dashboard, doesn't it? Key indicators. Can you give us a quick sense of what's flashing green, what's yellow, what's maybe red?
Sure. Flashing green, signaling positive returns, are things related to macro growth, like industrial production growth is looking decent, GDP growth relative to borrowing costs is good. Macro policy signals are also positive. Policy seems stable and predictable. Interest rate indicators, like the yield curve, look constructive too. Even some sentiment and corporate earnings indicators are positive. Where it's more neutral, kind of yellow, are certain valuation metrics like price to book, and maybe some sentiment flows. The main headwinds, the potential reds, seem to be around liquidity, both global and domestic money supply, and the overall market cap compared to the money supply. That suggests even with good fundamentals, tight money could be a drag.
Got it. So for investors trying to navigate this, what's the recommended strategy according to the report? They favor certain sectors, right?
Yes, they have a clear preference. They favor domestic cyclicals companies tied to the Indian economy's ups and downs over defensives, or those heavily reliant on exports. Specifically, they're overweight financials, consumer discretionary, and industrials.
Okay, why those three?
Well, the thinking for financials is that short-term interest rates have likely peaked, credit growth should pick up, and loan losses should stay low. Good setup for lenders. For consumer discretionary things people buy when they feel more confident, they expect urban demand to recover, more spending power. And industrials are set to benefit from strong government infrastructure spending, plus maybe the start of private companies investing more too. It's all tied to that domestic growth story.
And conversely, they suggest being underweight, energy, materials, utilities, healthcare. What's the logic there?
It fits the same theme. They generally prefer domestic cyclicals over global ones, like energy and materials often are. And they're leaning away from defensive sectors like utilities and healthcare right now. But they make a really important point. This is likely a stock picker's market, meaning it's not just about buying the whole sector. Success will probably depend more on choosing the right companies within those sectors. It's not a rising tide lifting all boats equally. They even give examples like ICICI Bank, Maruti Suzuki, Larsen and Toubro as stocks they rate overweight.
That emphasis on stock picking makes sense. So beyond the big picture, what about the health of Indian companies themselves? Corporate fundamentals. Is that shallow balance sheet recession really over?
The report suggests it could well be ending, yeah. You're seeing companies seemingly more willing to borrow again, which is a good sign of confidence. Debt issuance is picking up. And importantly, Indian companies' earnings growth looks better compared to other emerging markets. Profitability as a share of GDP is trending up. Return on equity ROE is improving too. Their base forecast sees earnings for the Sensex index compounding at nearly 17% a year through fiscal 2028. So yeah, the underlying corporate health looks pretty solid.
Okay, let's tie this all together with the market forecast. What are the actual numbers? They have a Sensex target, right?
They do. The base case target is 89,000 for the BSE Sensex by June 2026.
And the market was around 80,600 when the report came out in early August 25. So what does that 89,000 imply?
It implies about 10% upside from that August level. Valuation-wise, it suggests the Sensex would trade at a trailing PE of around 23.5 times. Now, that is higher than its long-term average, which is closer to 21 times, but they argue that premium is justified. Justified by better medium-term growth, that lower beta we talked about, potentially a higher long-term growth rate for India, and more predictable policies.
All right, so what needs to happen for that 89,000 base case? What are the key assumptions behind it? They give it a 50% chance, right?
That's right, 50% probability. The assumptions are basically things continuing on the current positive track. Continued macro stability via fiscal discipline, more private investment kicking in, economic growth staying comfortably above the real cost of borrowing. It also assumes decent domestic growth continues, the U.S. avoids a recession, maybe just slow growth there, and oil prices stay relatively calm. Oh, it also assumes a reasonably friendly outcome on the India-U.S. trade deal, maybe another 0.5% cut in interest rates by the central bank, and enough liquidity in the system. No flood of new share sales overwhelming demand.
Okay, that's the middle ground. What about the more extreme possibilities, the bull and bear cases?
Yeah, they sketch those out too. The bull case target is 100,000 for the Sensex, with a 30% probability. That would need things to go really well, like oil prices staying consistently low, maybe below $65 a barrel. That would boost India's finances and allow the central bank to cut rates more aggressively. Plus, maybe global trade tensions ease significantly and the government pushes through some major positive reforms like big GST cuts or progress on tricky stuff like farm laws. Earnings growth would be even stronger, maybe 19% a year.
And the bear case.
The bear case target is 70,000 with a 20% probability. This is where things go wrong. Think oil prices surging over $100 a barrel. That would likely force the central bank to hike rates to defend the currency and control inflation hurting growth. It also assumes a significant global slowdown, maybe a proper U.S. recession. In that world, investors would likely demand lower valuations, a derating, and earnings growth might slow to maybe 15%.
Okay, so just to recap the numbers for everyone. Sensex around 80,600 in early August 25. The base case target is 89,000, bull is 100,000, bear is 70,000. And when Morgan Stanley crunches those probabilities together,
They get a probability-weighted outcome of 88,500 by June 2026. So still leaning pretty positively.
right, well, we've certainly covered a lot of ground here. A deep dive into Morgan Stanley's view on Indian equities, from the big picture structural strengths right down to sector bets and market targets. The overall picture seems quite optimistic, really anchored in India's own unique story.
I think that's fair. The core message really is about those structural strengths driving a potential re-rating. And hopefully understanding these details helps you cut through the noise, make sense of the headlines, and maybe think more clearly about this really important market.
So what does this all mean for you? It's worth thinking about how India's evolution, this rising consumer power, the energy shift, manufacturing changes, might ripple outwards. It's not just about the stock market. It impacts global trends, opportunities across many industries. And maybe here's a final thought to leave you with. Given this projected rise of India as an economic force, how might that reshape the landscape for other emerging markets, or even for established economies over the next decade? What does it mean for global trade flows, for investment patterns? Something to definitely ponder.